Wow, thank you very much. And welcome, everyone. Thanks for spending a few minutes with us. I want to talk a little bit about exchange business models. And really, our business is really around customer access strategies. So a lot of the global exchanges are starting to reach out into new markets. A lot of global exchanges are investing heavily in data center assets. And this is all part of what we call the customer access strategy. The key place I want to focus is 5 traps that you need to avoid. And as Robert said, we service over 80 exchanges around the world. I've personally met with about 100 exchanges around the world just last year. And some of what we do is talking about their current predicament and how to get them out of that predicament into a better space. So again, thanks for joining. So really, where our expertise comes from is the customers we serve. We have now almost 500 asset managers and brokers, so we serve both the buy side and the sell side. Interestingly, in Equinix, the buy side is actually growing at a faster rate than the sell side. People often think of proximity trading, and they think about brokers, high-frequency trading, low latency, and that's not the case. Our data centers are very well connected with news and information sources, and that's driving an inflow of a lot of buy sides. On the right side, you see the technology service providers and venues. So we actually provide services for companies like New York Stock Exchange, like the CME in Chicago. We're a service provider for exchanges that have their own data center assets. And oftentimes we provide what are called points of presence for those exchanges, either in local markets or in foreign markets. The other important group that we host is what we call technology service providers. So if you think about the market data firms, you think about the extranets, you think about the network providers, telecommunications firms, they're all part of that group of 225. And what's interesting is we broker conversations between those two parties. So your exchange may not be a customer of ours, but we've probably had dozens of conversations on how to connect to your exchange, how to gain market data from your exchange, or how to send order flow through brokers to your exchange. So we sit between a lot of these parties, and we really act as a concierge between a lot of these groups and service providers. So why does this matter? And I think now it matters more than anything. There's a lot of money at stake. New York Stock Exchange, spent over $500 million US in a couple of data centers in Europe and the US. Deutsche Börse made some announcements that they were utilizing Equinix. NASDAQ has ramped up and invested heavily in data centers, and we see this all around the world. Hong Kong Stock Exchange, I was there 2 weeks ago. They invested $1 billion Hong Kong dollars, $100 million US dollars in their data center. The same in Sydney. We're seeing the same in Singapore. And I think what's important is you have to get it right. You need to make sure that you don't paint yourself into a corner, that you set your exchange on a trajectory for growth, and you don't limit your options in the early stages of these decisions. And it's very easy to fall into one of those 5 traps. So we really look at the customer access strategies as 5 different areas. And we look at the matching engines or remote points of presence on a kind of a 2-axis chart. We look at growth of the facility, and we look at maturity of the connectivity strategy. So you can see the 2 axes of growth here. And then we break it down into what we call 4 stages. And each of the 4 stages has a different value based on what the strategy is. So what we call stage 1 is typically an exchange-owned data center. So there's a little bit of headroom. Typically, there may be a growth plan, but typically it's one building. Oftentimes it's a very large building. And then there's oftentimes a local phone company providing service to that building. So if you think about some exchanges, for instance, ASX in Sydney, I was there a couple months ago. They have their own building. It's heavily serviced by Telstra, the local phone company. The issue here is sometimes there can be limited connectivity outside of the country or outside of the region. And it's important if you make a stage 1 type decision, if you own your own building and you're working closely with the local phone company, that you make sure that there's access by other global network providers if you have a multinational client base. The second stage is we've seen a lot of exchanges migrate from stage 1, their own building, into what we call stage 2, which is they outgrow their existing data center. They need to move into a facility with more headroom. They need to be better connected to the global markets. So think about NASDAQ. They were in a stage 1 facility called in Trumbull, Connecticut, and then they moved into a Verizon facility in Carteret, New Jersey. They immediately gained more headroom because of the size of the data center, and they also had more connectivity because they were essentially in that phone company POP. They were heavily dependent on that time at MCI and Verizon, as it's known now, but they immediately got more connectivity, which is that top green area. What we call the third stage, and we've seen a lot of exchanges in this stage, is a financial extranet. So companies like BT Radiance, companies like Savvis, that have connectivity around the world, you can immediately bring your exchange up and connect to thousands of broker-dealers or market data providers all around the world. One of the things you have to be careful here is that oftentimes there's a local phone company, there's an extranet, but the phone company can be very territorial on global networks coming in, and there can actually be a tax for foreign phone companies coming into that local market. Hong Kong is a great example of that. Then stage 4, which is really maximizing the headroom, maximizing the connectivity. Again, we have customers that are in what we call stage 1 with their matching engine, but they go to stage 4 for their access nodes or their points of presence around the world. Stage 4 is what we call maximizing connectivity. In a lot of our data centers that host exchanges, we have 40 to 50 networks in use by the financial service firms. And we really think about exchanges as being at the center of a vascular system, the vascular system being electronic trading. And we think of the exchanges as being in the heart of that vascular system. And we think it's important to have really unconstricted flow outbound of market data and trade execution, and unconstricted or unrestricted flow inbound into the matching engine or the access node. So stage 4 is what we typically see as the most mature. We've seen some exchanges go from 1 to 2 to 3 to 4. We've also had some exchanges jump from 1 to 4, some of our customers. But if you think about number 4, you know, Deutsche Börse just made an announcement that they were going into Equinix. They needed to be into something, a data center that was very well connected with the rest of the world. That's a good example where you've got an exchange and exchange clients that are using dozens of different networks. Another example is New York Stock Exchange. We host safety in Asia, as well as Europe, as well as North America. And they use us for access nodes, or what they call safety, in these markets, again, to gain access to more global network providers. So some considerations on remote points of presence. It's important you define the geographic profile of your immediate liquidity base. So think about the member firms that you're servicing, and if your strategy is to expand the member base. So for instance, in Japan, there's an initiative called remote membership. Even though local brokers are the only one that can exchange on the TSE or on the OSE, and even though your technology has to be resident in Japan, they're trying to create remote members that can trade with those member firms. So it's very important that that order flow arrive into Japan, and that may be coming from markets like New York or Chicago or Hong Kong. So really define that geographic profile, not of where you are today, but of where you're going to be in the future and where liquidity will flow from. The next is to think about customers of the liquidity base, so time to market and cost. So if you have barriers to entry in your market, like network providers, if you're in a very remote geography and the only connectivity provider is the local phone company, like in the example again of Japan, customers in Europe may not want to sign a contract for 5 years with NTT They may not have a big enough spend, to get a good price to connect into Japan. So think about utilizing, companies like BT Radians or Savis or TNS. The other side is think about the technology service providers. If you think about the market data providers that take your order flow outside of your exchange, it's important that you think about the outside world having visibility in your exchange. And this is done mostly by market data firms. So the companies that are normalizing the data, turning the multicast data into a unicast packet, turning it into a message-based service, market data firms that are essentially aggregating different feeds from different markets. This is critical that you work with the right providers. Again, this is really based on your geography, but if you don't have the right service providers early, it's going to be very hard to grow the volume in your exchange. And then lastly, think about a growth strategy, rich connectivity, and you want to be able to connect inside and outside the market. This may include major liquidity points that already exist in your market. So I use the example of New York Stock Exchange. They have their own data center in Mahwah, New Jersey, but they also extend safety into remote liquidity sites where there are a lot of trading firms and even different exchanges. And they are able to connect to that liquidity or order flow remotely. So let's go on to the 5 traps. So the first one we call blinded by latency, and often when I work with smaller exchanges, there's too much emphasis, what we call on-premise, or thinking of the 4 walls of the data center. So there's a myopic focus on things like cable length, or having the right broker-dealer mix, or limiting the cabinet or cage space for each firm so you can get 200 or 300 firms. We think that really the volume and value driven to an exchange is based on what we call an ecosystem. And we see too many exchanges focused just on the 4 walls of their data center. We think you need to think outside, but I think that's probably the #1 trap, especially for smaller exchanges. Next is what we call high and dry. So this has to do with connecting to different liquidity sources. And remember that your members need to route order flow out of the data center, and you also want to take order flow into the data center. So the markets, especially if your member firms are multinational in nature, they're going to be trading in dozens of different cities around the world. They're going to be trading cash equities, but they'll also be trading options, they'll be trading FX, and being connected to liquidity sources that may be a different asset class than your exchange are really critical. The other side, and we've seen this a little bit recently, is choice of one, or what we call the company store. So exchanges have invested sometimes in their own data center to essentially create barriers of entry. It's important that an exchange, when they invest in their own data center, they want to be able to chart their own course, and they want to own their destiny. It's an expensive way to do that, but I think the flip side of that is if you don't have rich choices, if you don't have enough market data providers, if you're limiting or constricting network order flow, or order flow from networks, that company store effect can be pretty dramatically bad. Next is no headroom. So we've seen exchanges move brand new high-speed matching engines into facilities that were essentially full. Think about the SGX. They were using the phone company, a stage 2 strategy. They were using Singtel out of space and power, and so they launched brand new technology, but it was a very constricted space, not a lot of room for new members, and not a lot of room for the exchange to add new technology. And then the 5th is what we call one-man band. Be careful of vendors that claim to be everything in the world, because they can somewhat limit your choices down the road. And I'll drill into each one of these. So we think one of the myths in our business is really around low latency, high frequency trading. This gets all the attention in the media. It also, like I said, it can blind exchanges when they look at their strategy. But the myth is that your matching engine will be close to algorithmic trading. There will be piles of cash on the floor, both for the member firms and for the exchange, and we know that to be false. The balancing act is really around getting quality order flow, and most of that arrives from buy sides and asset management firms. High-frequency trading can sometimes introduce too much predatory order flow, and you can actually damage the market share or volume in your exchange if you focus too much on HFT or low latency or proximity trading. The high-end dry syndrome. So if you invest, hundreds of millions of dollars in a data center, and again, your order flow is constricted, or you don't have the right market data providers to get the information out of your data center, there will be not very much liquidity in that data center. So beware of having too few of connectivity choices. Beware of having too few technology service providers. Beware of having too few market data providers. We have many companies, for instance, in New York, where they're using a dozen different market data firms. And firms tend to layer different service providers. And it's important that you have connectivity and service providers that can link to all those services. Trap number 3 is what we call the company store. And I think in the financial markets, we definitely, talk about the ecosystem as being important. The ecosystem is really about having a rich choice of vendors and a rich choice of consumers or revenue streams for your member firms. So if you've got a market data offering and you're an exchange, or if you've got a financial extranet and you're an exchange, you have to understand that firms will not put a good part of their infrastructure in your data center if they can't get all the services. If you have market data and it serves 10% of that firm's needs, you're only going to get 10% of their market data infrastructure. The other 90% will be spread around data centers that offer those other service providers. So the company store mentality can be very limiting in the firms that are attracted to your site. And again, you'll only attract a sub-segment of their infrastructure. And it's very important to avoid this. Trap 4, think about Headroom for yourself. Think about Headroom for your customers. If you're investing hundreds of millions of euro or dollars in data centers, Headroom is very important. And so is advancing a slide. There we go. So you can see this poor fella without a lot of headroom. But we have seen exchanges invest in new points of presence, invest in global networks. They're taking their company store essentially, or their local brand into Europe or into Asia, and their network is terminating in a data center that has no space or power. There's no headroom for firms that want to connect up with their market data feed. And so you're essentially limiting all of the options that you set out to gain by investing in these global wide area networks. So it's really important when you build this bridge to Europe, or you build the bridge to the Americas, you build the bridge to Asia, you know where that bridge is going to land, and you have to make sure there's adequate headroom, again, for both you and the member firms. Number 5 is what I call the one-man band syndrome. But it's interesting, at Equinix, when I meet with exchanges, I talk about the fact that we have concrete floors, and we have electricity, and we have air conditioning, and that's really our only offering. The ecosystem is not from Equinix, it's from the market participants, but it's very opposite or counter to the message that a lot of providers have. So beware of the providers, especially when it's a local provider that claims to be global. They may say we have the best network offering in the world, we have our own market data service, we have managed service, we have a cloud offering, and they also do things like hosting all around the world. So that's great. They may fill 6 or 7 of those different buckets, but typically they're not best of breed in every market. And so by signing up with a one-man band, you could be excluding some of the best choices in the remote markets. You may have a network provider that's great in Singapore, but a network provider that's not very good in London, or not very good in Frankfurt, or in Istanbul. So it's important that you really think about your options and you don't paint yourself into a corner and make sure that you've essentially created a dead-end strategy because you signed on to kind of the one-man band type of approach. So our goal is to make this easy for you. We've invested about $3 billion in data centers around the globe, and you saw some of the exchanges we're working with. You know, in the example of Deutsche Börse in Frankfurt, we're expanding now into our fourth phase, 14,000 cabinets. Nearly $1 billion will go into that facility when it's fully built out. So our goal is to invest in these facilities so you don't have to, and save you the CapEx requirements. Next is we've rolled out something we call Ethernet Exchange in 22 markets around the world. We think Ethernet is really the way forward in the financial markets. I mentioned network connectivity. We think this will really make it easy for companies to acquire bandwidth from key cities like Chicago, Tokyo, London, New York, etc. And so stop by our booth. We'd love to talk to you about this platform. Next is we're very focused on new geographies. We've made acquisitions in Rio and Brazil. We're looking heavily into Mumbai and Moscow right now. So we'll stay ahead of the markets, and we'll stay in the markets that are interesting, like Shanghai, Beijing, and Mumbai. The other side is that we use best practices from all around the world. So we're really known as having state-of-the-art facilities, because that's all we do, is build these data centers. And we try to ensure headroom. We typically build out campuses of multiple buildings in a market. And so our goal is to make sure that we have the most up-to-date technology to serve exchanges. I just want to give you a quick slide on the financial peering platform. This is actually based on the Ethernet Exchange. And I know that a lot of exchanges are looking at extending their market data into foreign markets. The issue today is that if you're an exchange in New York, you've got market data providers in London that are long-hauling that market data between New York and London. So in this case, if you got 15 market data providers, there's probably 30 long-haul circuits or 15 pairs of circuits going between New York and London. It's very expensive, and it doesn't scale. Same with London back to New York. We see this all around the world. Our goal is to do something different. We're going to enable exchanges to connect to market data participants in foreign markets on our Ethernet platform. So in other words, a New York exchange can put their market data in London and have the local market data providers pick it up in London. That will reduce costs for the market data providers by up to 70%. It will also increase revenue for that exchange by probably 200 to 300%. So essentially, by skinning down the number of long-haul providers, the goal is to make it easy for exchanges to create a storefront or a presence in foreign markets. And that's what we hope to do with this platform. We've already got about 60 global networks signed up for this platform. And again, we'd like to go deeper on this topic if anyone's interested. What we think that this will do is, by creating these very dense interconnection points, we think that these global peering points for the financial markets will create new opportunities. We're not in any of these businesses, but if you think about multiple exchanges in a market, concentrating their market data in one area, you've got these opportunities for consolidated tape, potentially for unified timestamp across different asset classes. You've got things like intermarket linkage, so Reg NMS in the US, order protection rule in Toronto as an example. Exchanges need to efficiently route orders, and we think this platform will enable that. Also, there's a significant decrease in market data costs, and we think of these as kind of cross-asset meeting places. We're already seeing that in markets like London, Chicago, New York, and Tokyo. The other side is companies that offer things like tick history. You've got a major consolidation point where you can collect information from multiple exchanges. Again, this doesn't have to be local. It can be regional or global exchanges. And lastly, efficient order routing between exchanges. So we think that on top of this platform, new service providers will emerge, market data providers, and they'll be able to link in these neutral meeting places all around the world. And we've installed this in 22 global markets at a cost of about $50 million. So if you need something that gives you remote access or remote capabilities into some of the larger financial markets, you don't have to invest in the switch platform. We've got it. We also have the network starting to sign on and test for this platform. Thank you very much. I wasn't that thorough.
My name is Ibrahim Aradi, Head of Trading Bahrain Bourse. Thank you, John, for your nice presentation. And if we recognize that these 5 traps you mentioned earlier is a sensitive and key for success of any exchange, what are, from your perspective, how to overcome these traps and make it visible for the investors, the customers, and for the growth of the exchange?
That's a great question. We work with 8 of the top 10 exchanges. The other 2 we're working with are really doing due diligence around that question. So I think visiting with alternate providers, talk to Equinix, talk to Interaction, talk to Global Switch. We have a utility database that maps all the financial points of interest in the key markets that you can have access to, that will enable you to kind of look at the connectivity model around the world. But I think sitting down with different vendors and getting a broader perspective of the markets and finding out the specialties within each local region, and they vary all around the world. So I think the exchanges that I work with that are most successful are also the most vigilant in collecting information from different sources. And I think I was talking to someone from the London Stock Exchange. They use multiple providers. They're agnostic in their strategy. And even though I work for a data center company, I think that's the single most important thing you can implement in your strategy is plan to use multiple providers and use the best of breed in each market. But don't limit yourself to only one provider. Talk to as many as you can and use more than 2. Does that answer your question? Thank you.
Hi, John. Peter Randall from Equinix. We use you and we like you. Thank you.
Thank you, Peter.
On your peer-to-peer thing, it just seems to me that you're missing a huge trick, and your stockholders and customers must be a bit upset, I would have thought, because why don't you just put a badge on it that says stock exchange? Because you're already the biggest in the world. Surely if you've got all these people connected, you've got all this market data, you've got all this super fast stuff, all that really is just a technological development of pulling together all these regional nodes and having, what Deutsche Börse and our friends at NYSE Euronext spent many hundreds of millions of dollars trying to do just very recently.
So that's a great question, and we get a similar question quite often. So Peter, it's kind of counterintuitive. We're known as the best connected data centers in the world, and that's because we don't have our own network. We have a global sales force that attracts Deutsche Telekom and BT and AboveNet, spread networks. We have almost 700 networks around the world that are in our data centers because we don't have our own network. We host 80 exchanges because we're not an exchange. We host every major market data provider because we don't have a market data offering. So it's very counterintuitive, but our core business is very strong. Our stockholders are very, very happy. And I think it's the discipline to stay out of those businesses and let the best of breed providers provide the service is key to our growth. And that's really actually something that I focus on in our company. I try not to roll out new products that compete with our customers. We try to, speak with our customers so that they'll roll out that product. Does that make sense? Sure. Okay. So I think it's the discipline to stay true to your core business, and again, to attract the best of breed providers and have that rich ecosystem versus trying to be a one-man band, which is very difficult and expensive.